What is going on, everybody? This is S Trades, and this is day 8 of the bootcamp. And in this video, we're going to be going over premium and discount, also known as the Fibonacci retracements, as you guys can see over here. Without further ado, let's get straight into the video. So what does all this stuff mean, premium and discount and things like that? So premium and discount is kind of self-explanatory. It says it in its name. Discount is pretty much whenever a stock is in a discount, right? It means that you could buy it for cheaper, and whenever it's in premium, that means it's higher price, right? So in terms of these levels that we have right here, we see at 0.5 level. So this is also known as the equilibrium or the golden zone. So golden zone, equilibrium, discount, premium, it's all essentially the same thing. Premium and discount is just in terms of ICT, and then golden zone is just like smart money concept and things like that. So what does it mean, right? So as a trader, you wouldn't want to be entering longs in this case, right? We have this very big displacement, right? We don't want to be entering longs at the top over here, right? What you want to do is instead you would want to see price come into that discount zone, also known as the equilibrium or the golden zone, right? Which is this number, which is the 0.5, right? Or the 50% retracement of the move, right? So you would want to see price retrace to this zone, right? Or even lower, which be better for your risk to reward, right? Once price kind of taps into this 0.5 level or even goes lower, now this whole entire inefficiency, right, is rebalanced, and now we can start looking for longs because now price is at a discount, right? Price is cheaper. It's not very expensive at the top over here, right? Now, same thing for the short position, right? You wouldn't want to enter a short all the way down here at a discount level because it's too, like, it's not ideal, right? So what you want to do is you would want to wait until price retraces back into this golden zone, this equilibrium level, right? And it could go anywhere from 0.618 or even higher to 7.9, right? 0.79. So all of this, any of these zones above the 50% is known as premium, right? So anywhere between from the 0.5 level and up is now a premium and is good for you to short, right? So think of premium discount like a sale, right? For example, you want to buy something when it's very expensive, right? You wouldn't want to wait until it hits the sale, right? Once it's a lot cheaper. Let's say you buy some crazy expensive shoes, right? And in this case, the shoes are like $10,000 or $1,000 over here, right? You don't want to wait until it kind of goes lower a little bit, like say $200, $300. Now it's at a very big sale, right? So now it'd be very ideal for buyers to step in and getting that demand high, right? So they would start buying in once price went lower at a discount level, right? Same thing for premium, right? As a seller, you wouldn't want to sell your thing like not expensive at all. You wouldn't want to sell your very expensive shoes that's supposed to be 1,000 for like 200, right? What you want to do is you want to see until the demand goes higher, right? So we want to see until price ends up coming at a premium, right? Once it starts getting more expensive, right? So in this case, price becomes more expensive, right? Let's say it goes back to like the 900s or 950, 850 and stuff like that, right? Now it's more beneficial for the seller to now start selling. And in this case, once price retraces to the equilibrium, right, the 0.5 level and higher, now we're at a premium, and then that's when sellers will step in. Okay, now what do all these numbers mean that are over here on the chart, right? So these are all, like for this bullish case scenario, right, these are all just very ideal numbers for price to bounce off and react off from, right? So 0.5, which is the 50% retracement, is the golden zone, right? This is the equilibrium. This is where price would be rebalanced, right? And if it goes anywhere lower, let's say to the 0.618 retracement, 0.79, that's even more discounted, and it's even better and beneficial for someone that wants to long to enter in here because he would have a very, very good risk to reward position, right? Same thing for a seller. Once price hits the 0.5 level, it means the 50% retracement is now done. We're at equilibrium, and anywhere even above that, it's at even more premium, so it'd be even more beneficial for a seller to enter. So now, how would you draw this fib tool, right? So let me make it again from scratch. So you would want to kind of see for a move to be at a very like heavy momentum displacement move, right? You wouldn't want to be seeing like choppy like candles. You want to see something like this. You see how there's a lot of displacement in this leg. So what you want to do is you want to draw your Fibonacci retracement from the swing low, right, from the previous low, and then you would want to draw it all the way up to the last high that made this bullish displacement move, and then that's pretty much how you draw it, right? And same thing for the bearish case scenario, right? Where you start the move from the top, and you would see where the price kind of started this very heavy momentum move with a lot of displacement, and then draw it from the high all the way down to the low, and now you have these levels, right? So now also, if anyone wants to copy what I have, these are the numbers that I have. I have the 0, 0.618, 0.5, and 0.79, and -1 right now. Don't worry about the negatives. That would be kind of talked about in a later video, but this is kind of essentially all you need. You just need the 0.5, 0.618, and 0.79, because these are the most prominent, these are the most significant levels for price to react off from. Okay, now price doesn't have to exactly tap these lines, right? It could be anywhere in between. It could be like over here, right? It could tap the exact line and then bounce off. It could be like anywhere in between. Now it doesn't have to exactly tap it. So that's what I'm saying. I mean, as long as you see that the price ends up tapping the 0.5 level, and then it's anywhere lower in between, is good. So literally this whole entire area, right, is discount. So anywhere in between these levels is good for you to long. Same thing for shorts. Anywhere above this 0.5 level, all of this is counted as premium and it's good for you to short and sell. Now for the visualization, right, like why would you want to be entering at a discount for longs and for premium for shorts, right? Now let's say this move ends up happening, right? We have a lot of displacement, right? You'd want to see for some sort of a retracement right now. You wouldn't want to enter a long, all the way at the top over here and then have absolutely negative risk to reward, because you have to have your stop like below here or something like that, right? This is just super negative, right? Same thing over here, like it's not as beneficial, right? So now you would want to see for price to retrace lower for you to have a lot of more better positive risk to reward. So once price enters the 50% golden zone, the equilibrium, right, now we have 1-to-1, right? Now the more it retraces lower, let's say the 6.618, see how we're starting to have 1.5 now, and let's say even if it goes even lower, let's say anywhere between, let's say 0.618 and 0.79, right? Price goes over here and then we see a reaction above, right? So now do you see how much better this is rather than for you longing all the way up over here? This is exactly why you would want to be entering longs at a discount, because that's where lots of actual buyers that move the markets are entering. They're not entering longs at the top, right, and then setting their stop loss all the way over here just for get like barely any money off of it. Instead, they would push the price lower, right, and then they would start being interested and start to participate in the markets once price is at a discount, once it's cheaper to buy more shares, right, once it's cheaper for them to enter, and then they end up capitalizing on that, right? Same thing for a short, right? They're not going to enter a short all the way down over here, right, and then have negative risk to reward, and then this have this massive stop all the way over here, and then pretty much get like absolutely nothing out of this move. Instead, what they want to do is they want to wait until it hits equilibrium at the very least. Like at the very least, you want to wait until price hits the equilibrium, right? And then a lot of the times price even goes higher. It goes maybe in between, or it goes even higher to the 0.618, and even a lot of times it goes to 0.79, which is a very deep retracement, and it's even better for you as a trader, right? Because now do you see how much money you'll be getting if the trade ends up playing out and how little you're risking? So the risk to reward is going to be a lot. It's mostly for risk to reward, but also that's where the institutional buyers and sellers kind of enter the markets, right? They're not entering at the bottom over here for a short. This is where the big buyers and big sellers are entering, right? Now, putting this together with the previous video that I made with the fair value gaps, right? Now, this is just essentially a tool for you to use. It's not just a solely like, okay, once we hit equilibrium, once we hit the 0.618 level, just enter the position. No, you have to put this together with some other concepts in order for it to work, right? So putting this together with the fair value gaps, right, where are you going to be wanting to enter, right? Like I said, you wouldn't want to enter at the top, right, when we didn't even retrace to the equilibrium level, right? You're not gonna enter along just because it hit this fair value gap and then hopefully you get this very little tiny position, right? No, same thing with this position. You wouldn't want to be entering this just because this fair value gap got hit. Instead, you guys want to be looking at the equilibrium levels, right? And then you also see that there's a fair value gap below the equilibrium level that also aligns with these fib retracements, right? This 0.5, 0.618, right? So now we have these two things aligned together. Now you'd be wanting to look at this fair value gap, right, for potential entry. And the reason why is because now we're very discounted, right? We have this 0.618 retracement, right? We have this fair value gap that's very discounted, right? So now these things start to pile up and give you more chances of price to actually go in your favor. So in this case, right, you would want to look for this fair value gap that's in a discount, right? Not these. So just ignore these fair value gaps that are not anywhere near the discount level, right? And instead just focus on the one that is in the discount, right? So now again, putting another concept together is inverse fair value gaps, right? So let's say price ends up coming all the way over here, right, to this fair value gap. It taps that fair value gap, gets respected, right? And then we see an inverse fair value gap, right? Let's say right here we have an inverse of a bearish fair value gap, right? So now we have three concepts going in together, right? So we have this higher time frame fair value gap. We tapped into the 0.618 retracement. We're now at a discount level, and then we get this inverse fair value gap of a bearish move. So now we enter that position, right? We could put our stop loss below here, or this previous swing low that was made, and then target. So now, as you guys could see, we have not just the fib retracement, not just the 0.618 and the discount level, right? We have the higher time frame fair value gap that's in the discount level, and then we also have the inverse fair value gap. So now we have three things going in for this trade. It's not just one simple thing over here, right? Same thing for the bearish case scenario, right? Same thing for the bearish case scenario, right? We have these two fair value gaps that are very, at the low of the move, you're not gonna want to enter at these two fair value gaps just because you're there, right? Instead, what you want to do is wait until price ends up retracing to all these inefficiencies, which is the equilibrium, right? The 0.618, 0.79, right? And then see if there's any fair value gaps overlapping with those zones, right? So instead, ignore these fair value gaps that are very discounted, right? And instead focus on the one that's at a premium, right? For a short, right? So now we see that we have a fair value gap at a premium zone, right? So now we want to see price retrace back over here, right? To this premium fair value gap and this 0.79. So we have two things combined together now. Now, let's say for your entry model, let's say you enter on inverse fair value gaps, right? So now the final step for the trade is for this little, like, let's say 5 minute, 1 minute, or whatever fair value gap to get inverse, right? Once price ends up closing below this fair value gap, right? Then, we make our move lower, right? So this is kind of how you want to be putting things together, right? And a lot of the times, right, even though there are fair value gaps at a, higher levels, right, they're still going to get somewhat like respected, right? So in this case, right, what would happen is price ends up coming to this fair value gap, right? Kind of gets a little reaction, go up a little higher, but then eventually it would still go lower. Like, so let's say price comes into this fair value gap, get a little mini reaction, and price ends up going lower, right? To this next fair value gap, right? Then we get, again, a little mini reaction over here, right? Kind of consolidate a little bit, but then boom, we end up going lower, and then finally to our, discounted fair value gap, right? So don't just expect for price to just straight up dump to the equilibrium. No, it's not gonna do that, right? Same thing for a bearish case scenario, right? We're probably gonna chop around a little bit at some sort of discounted fair value gap. So let's say there's a fair value gap over here. Let's say there's a fair value gap over here, right? We come into this level, right? Kind of get like a little mini reaction, right? But then eventually we kind of come up here again to this fair value gap, get a little reaction, but then we eventually go up to our premium level, right? Premium fair value gap, and then we would react off of that and then make our actual move lower, right? So this is kind of how you want to be seeing these premium and discount levels, putting them together with fair value gaps and other confluences. So now let's take a look at actual real chart examples. Okay, so starting off here, right, we're on a high time frame, we're on a 4 hour, right? So you see this clear, clear low, clear high, and then a lot of displacement in between, right? So what you want to do is, take your fib tool, right, and draw the fib from the bottom of the move, from the low, all the way back up to the high, right, and then see where the equilibrium level is at. So we could see that there are some fair value gaps right here. You see there's a fair value gap over here, there's a fair value gap over here, right? And you guys can see, like, on this, for example, if this fair value gap, we get like a little mini reaction off of these two candles, right? You see this longer wick over here and another wick over here, but we don't actually see any follow through up higher, right? So instead, what you would want to do is you kind of want to ignore those fair value gaps and look for an actual move that's below the equilibrium level, but when it's more discounted, right? So now we see that we have another fair value gap down here that is very discounted, right? Boom, we have this 4 hour fair value gap, and then it lines up with the 0.61 retracement and the 0.5 equilibrium, right? So you wouldn't want to try to enter longs anywhere above over here, because that'll just be negative risk to reward. So instead, what you want to do is wait until it comes to equilibrium level, and in this case it's this 0.550 retracement level and this 0.618, and it lines up with this newly 4 hour fair value gap that hasn't got touched, right? So you guys could see that it perfectly matches together, right? You see that we come all the way over here and get an immediate reaction once we tap this fair value gap, right? And then we see that price ends up following through and making the move higher, right? So now you could also pile this together with a lower time frame, right? So you see that now all of this inefficiencies that were over here, we got rebalanced, right? Price ended up coming lower, filling in those orders. Now the big buyers stepped in the market, and now we're starting to see an actual move higher, right? So now we could also capitalize on a smaller time frame, right? Let's say you missed on that move. we see another leg, right? You see there's another displacement over here from this swing high to this swing low, right? We see that we made a lot of displacement and a lot of, see how this wick ends up sweeping this low, right? Sweeping this low. Like I said in the previous video, we have liquidity sweeps, right? So we had a liquidity sweep of these little two lows, and then we had an immediate reaction high, right? We broke through this high, candle ends up closing above it, right? We had a lot of displacement, and we have this 4-hour fair value gap again, lining up together, right? And then what happens then? Price coming all the way down to very, very discounted zone, which is this 0.79 level. And then what happens? Price ends up, going higher. So now this constantly keeps on happening on every time frame and within time frames and within moves. So it's not necessarily just this very big retracement, right? It could also happen on a smaller time frame, which is over here, right? So now let's keep on going. We have another clear swing low, swing high, right? What's over here? You have another big 4-hour fair value gap over here, right? Lines up with this, right? Gets tapped multiple times, right? So what happens? Price gets a very heavy momentum push up higher, right? You don't want to enter longs anywhere at the top over here. Instead, you want to wait until it comes lower to this equilibrium level, which is perfectly, as you guys can see, price ends up tapping this 0.5 level and then pushing up higher, right? So now erasing this, going even lower, the new leg that got created, right? New low, new high, right? New swing low, new swing high got created. What happens then? If let's say if you missed on this long opportunity, right, we get another one, right? So now instead of trying to do something over here, we have this new leg that got formed, and then price ends up again coming back down to the 0.79 level. And again, what do we have? A lot of displacement and follow through, right? Another example, right? What do we have here? We have this very big candle, right, ends up forming. Now sometimes you do see that price ends up kind of retracing a little bit and then kind of reacting off of it, but the actual and like original move, the big moves and the big moves in the market wouldn't happen until the range is now rebalanced, right? Once the premium or discount got hit, you're not really actually going to see like a big move, right? So in this case, we draw a fib from this swing high to the swing low. Although price didn't retrace back to the equilibrium level, we did get a little reaction. But now if you extend it lower, right, and see that price ends up coming higher, right, sweeping this high, right, sweeping this high, coming all the way back up, because we have this very huge, right, 4-hour fair value gap that gets up left over here, right? So we kind of fill it up almost all the way, and then we come all the way higher to this premium level, making the 0.79 retracement, and then you guys can see we make the actual move lower, right? And then again, we see this happening on another time frame, right? Another move, another new leg that got created from this swing high to this swing low, right? So now let's zoom in, right? What happens here? Make a little swing high, swing low. Price comes to this 0.79 retracement, goes lower, right? Now, if you look at the bigger picture now, right? So if you make a fib retracement all the way to this new swing low from this swing high, what do we have now? We have this massive 4-hour fair value gap over here, and then price ends up coming lower and then retracing back to these inefficiencies, which is this 0.79. We hit the premium level, we hit the equilibrium, we went even more deeper into the premium, right? And then we ended up pushing lower, right? So this constantly keeps on happening, like I said. Now you could target the opposite direction, like I mentioned earlier, right? So let's say we drew this fib from this high to this swing low, right? Now we see that we have this 0.5, which is just equilibrium level over here, right, for a potential short, let's say, right? Let's say you're thinking to short once it gets over here. So what you could do is you could enter in the opposite direction, right? So once we make this little swing low, right, what you could do is see if price ends up, getting displacement. And then once it does, which is it does in this case, right, you could draw another fib, right? What do we have here, right? We make this swing low to swing high. We see the displacement going higher. Now we have this equilibrium at 0.5 and then 0.618, 0.79. And as you guys can see, we have a lot of reaction here. We see that these two candles coming all the way lower over here and these massive wicks that got left behind. So I don't know if you guys remember, but my previous video talking about the candlesticks and how there's like buying pressure and then buying power in terms of like buyers and sellers, right? So this is what you want to see once you see price retrace to these Fibonacci retracements. You want to see these longer wicks get left over right behind, because that shows that this price is getting respected and buyers are stepping in this case, right? So price ends up coming all the way discounted back to this 0.79 retracement and then pushing higher. So now in this case, right, you could target this 4-hour fair value gap, right? You can target this 4-hour fair value gap and this 0.5 retracement on the higher time frame. You see how on the higher time frame we have this very extended bearish move, right? So you could also target a long, right, to back up to this 0.5 retracement level, which exactly gets hit. And then as you guys could see, now we're flipping direction, right? So now we're not bearish anymore, we're starting to flip bias. Now we're becoming bullish, right? So now if you draw another fib retracement from this swing low to this swing high, right, what happens then? Price ends up, see how we have a lot of displacement through this high. Right now we're kind of starting to see some market structure shift, right? Like I said in previous bootcamp videos, right, we left this massive 4-hour fair value gap, right, left this massive 4-hour fair value gap. And what happens? Price ends up coming lower to this 0.5 level and to this 0.618. You see how the price didn't exactly tap this 0.618 level, but it's in between. It's in this golden zone, right? It doesn't matter. It's still counted as valid because we now have this 4-hour putting together with this equilibrium level. And then what happens? Price ends up pushing high, right? Same thing in this scenario, right? This just constantly keeps on happening. New swing low, new swing high over here, right? What happens? Create a new 4-hour fair value gap over here, right? That lines up with the equilibrium level, which is the 0.5 and the 0.618, right? And you see that price comes all the way low over here. Seeing how it left a very massive wick. Now this is a very good sign that price is respecting this level and a potential buyer, a very large buyer, enter the market. And then what do we see then? We see price ends up pushing higher. So as you guys can see, this just constantly keeps on happening. So now this, like I said, time is fractal, right? And these Fibonacci retracements, these premium and discount levels happens on all time frames, right? Going from the highest, which we're on right now, in the 4-hour, right, all the way down to the 5-minute, the 1-minute, and everything like that. So let's say for this case scenario, right? So we have this big bearish move that ends up happening, right? A lot of displacement, right? So let's say if your original plan was to see this level get hit, right? We say you wanted to see a continuation bearish play, and you would want to see price retrace back to these. Let's say this was your target, right? This 4-hour over here, right? And the 0.618, let's say, right? And the 0.5, which is the equilibrium, right? What you could also do is enter a long to kind of target those levels, right? If you go on a lower time frame, right? If you go on a lower time frame, right, we see that price hasn't hit the equilibrium yet, right? We're not, the range isn't rebalanced yet, right? But what we do have is, once we make this clear swing high to the swing low, right, we could draw another fib retracement, right, to kind of enter like a little reversal position, right? So we see that price ends up tapping the equilibrium level, right, the 0.5, and then we see follow through back up to the levels that we were looking at, right? So we were looking for this 0.5 illustration and this higher time frame 4-hour fair value gap. So you see how we entered a smaller time frame position, right, to enter the higher time frame bias, right? And now the higher time frame fib retracements, the higher time frame premium and discounts would always hold more power, right? So you'd have to keep in mind that this is a higher time frame move that could potentially happen. So if you're looking for to scalp, you got to be really careful and kind of just monitor your position. And then once you kind of hit this level, as you guys can see, there's a lot of premium levels that were hit in this case, right? So we hit this 4-hour, kind of got a little mini reaction, right? And then what happens then? We price kind of came up higher, right? Sweeped out these highs, made another move lower, right? So then what happens then? Price again ends up going again, sweeping out this high and going all the way deep to this 0.79 retracement to then actually make the, you know, move that was supposed to happen, this big short and the big sell that ends up entering in this market. And then boom, we see that price ends up going lower, and then we see that initial move. So you guys can see how all these concepts start to kind of coming together. We see a lot of liquidity sweeps happen, right? We have a fair value gap that gets disrespected, and then we see that these premium and discount levels get hit, and then price is filling those inefficiencies to actually fuel the move either lower or higher. So again, let's look at more examples, right? What do we have here? We have a clear swing low, swing high to this swing low, right? and it lines up with this order block, right? I haven't went on order blocks yet, but I have this higher time frame order block, and we see that there's a 0.618 retracement level that gets hit, and price ends up pushing lower. But then also, if you look at a lower time frame, let's say if you want to enter the short, right, but this kind of ends up happening over the period of 2 days, right? So if you don't want to say wait 2 days and you want to capitalize on some sort of a move back up to this inefficiency that needs to get rebalanced, because price can't just go down without filling out inefficiency. So in this case, right, let's say if you were looking for some sort of a play back up here, we see how price comes lower, right? And then we have this higher time frame, this yellow line, which is the equilibrium level, right? And then the 0.618, which is the orange level, right? So we have over here this 5 minute, right? So price starts kind of getting displacement up, back up to the highs, right? So we have a little swing low, swing high. We draw out the Fibonacci retracement tool, right? What do we have here? We have this 5 minute fair value gap also lining up with this 0.618 retracement, right? And then putting it, let's say, with the entry model, which is the inverse fair value gap, right? So what do we have here? We have another 5 minute fair value gap that ends up getting inverse, right? So now we have 3 things coming in together for this one long, right? So the more confidence that you could put in for a trade, the better, the more confidence that you'll have. So in this case, your high time frame narrative, high time frame look is for price to retrace back to the equilibrium, which is this yellow zone right here, right? So now let's say you want to capitalize on a long back up to those levels, right? Back up to the equilibrium level. So now we have this higher time frame 5 minute fair value gap that gets tapped, that aligns with the 0.618 retracement, and we have this inverse fair value gap, which has also been mentioned in the previous video for the fair value gap. So in this case, let's say you want to enter a long over here, right? Say your stop either below the swing low, or if you want to be extra safe, you put it below the original swing low, and then you target the equilibrium level. And as you guys can see, it ends up working perfectly. You see how we kind of tap into this 5 minute inverse, also aligning with the 0.618 retracement, which is very discounted, and then price ends up making the move back up to the equilibrium and the 0.618. And then as you guys can see, now we're starting to see a reaction back down lower. So now what do we have here, right? So we see how we came all the way to this equilibrium, to this premium zone, right? There you come in higher again, tap this 0.618 retracement, and then what do we have? We have a liquidity sweep over here. Price ends up coming up over here, making this fake move, taking out this high, and then making an actual move lower, right? So you see that price ends up rebalancing this level, right? The more discounted, the more premium in this case for the short it is, the more likely it is for it to work and have this very aggressive push lower, right? So because again, what's the kind of concept behind it is that a seller wants to get the best position possible, right? He doesn't want to short anywhere over here. He wants to short above the equilibrium level when it's very, very high in premium for him to capitalize on the risk to reward, right? So let's say for some reason, right, you weren't able to capitalize on this move, right? Once it came to this 0.618 retracement, and it almost came and tapped this 0.79 retracement, right? Let's say if you weren't able to capitalize on that, you have another opportunity in this leg, right? So this new leg that got created. So let's erase it now. But keep in mind, right, we're in this level that got rebalance, right? So this inefficiency, this big move now is rebalanced, and now we're expecting for price to move lower, right? So now we could also enter on a lower time frame. Now what do we have here? Now remember how we came and rebalanced the inefficiency. We tapped the 0.618 retracement, and now this is on a 5 minute. We were just on a 4 hour, right? So now on a 5 minute we have another levels aligning together, right, which is this 5 minute that ends up coming, making this very aggressive push lower, right? So what do we have here? We draw the Fibonacci retracement from the high to the low, and we see that if you are entering a short, you wouldn't want to enter a short anywhere above this equilibrium level. So everything over here is valid and it's premium for you to enter a short, right? So what we have over here, we ends up coming up on the 0.618 retracement, we tap it, and then we start to see reaction, kind of come up here, see another reaction, play around a little bit with it, and then price ends up dumping, right? So this constantly keeps on happening, and then we even see it over here. We see another leg. So let's say if you missed out on this move also, right, now you have another chance to enter over here, right? So we have another leg that was made with a lot of displacement, a lot of momentum down, right? So now we could also draw the Fibonacci retracement on the lower time frame, which are on the 5 minute. Again, from the swing high to the swing low, what happens? Price ends up coming into this 50% equilibrium rate, and we're now premium. And then what happens? Price ends up pushing lower. So as you guys can see, this happens on from small time frames all the way up to the higher time frames. So it's just a matter of putting these things together to have a lot of confluence, just kind of together for a single trade. It's not just, you know, it's not just me looking at this level and be like, okay, well, it hit the 0.5, just short. You know what I mean? No, it's a lot of things like the fair value gaps, right? The high time frame narrative. We are in a very high time frame bearish trend, right? We hit the higher time frame 0.618 retracement, right? We made this move, right? This got respected, so we have a lot of bearish PDRAs that are getting respected. So now we have a lot of bearish kind of biases kind of coming together and building our confidence, which is why in this case this also got respected, right? So this is it for this video. This was just a video kind of to show how the inefficiency get rebalanced, not only with the fair value gaps, but also with this very, very important Fibonacci tool, right? The premium and the discount levels, they're very, very important. They constantly kept on working day in and day out because this is where the big buyers and big sellers enter. So this is the mindset for you to have, you know, if you want to long at a discount. If you want to short at a premium. This is always going to help you. It would never hurt for you to, like, you know, long at a discount and short at a premium. However, it would hurt you if you long at a premium and then you would short at a discount because their range isn't rebalanced, right? We have a lot of inefficiencies to fill out, so you're most likely to get either faked out, and then that's when you could kind of start putting things together. As for example, there's a lot of fair value gaps in the leg, right? So just pay attention to the fair value gap that's in a discount level if you wanted to enter long, let's say, right? So, you know, these things you just kind of start putting together, and then things are starting to eventually make sense. So this is it for this video, guys. If you don't understand anything that I just mentioned about the premium and the discount or fair value gaps or anything like that, drop them down in the comments and I'll help you guys out. So yeah, that's it for the video, and I will see you guys in the next video.